Remember Blockbuster? Yeah, GameStop, the place where you used to rent dusty DVDs, became the unlikely hero of a financial saga that left Wall Street bewildered. Picture this, a bunch of everyday folks armed with smartphones and a Reddit forum, taking on the titans of finance and winning. It was a David versus Goliath showdown for the ages. And for once, Goliath blinked. This wasn't just about video games. It was about sticking it to the man, a rebellion against the perceived rigged game of Wall Street. The little guys, fueled by memes and social media, managed to turn the tables on the big institutions, proving that even in the complex world of finance, sometimes the underdog can have its day. For years, hedge funds had been raking in billions by betting against struggling companies like GameStop. They were the big sharks, circling, waiting for the inevitable demise of these brick-and-mortar dinosaurs. But the rise of online communities like Reddit's Wall Street Bets changed the game. Suddenly, thousands of individual investors were banding together, sharing information, and coordinating their trades. They saw GameStop not as a dying relic, but as an undervalued asset, a company with potential for a comeback. And they decided to fight back against the hedge fund's pessimism, buying up GameStop shares with a vengeance. Every good story needs a hero, and in this case, it was a man known as Roaring Kitty, a YouTube personality and financial analyst with a knack for spotting market trends. He saw the potential in GameStop long before the masses, consistently pushing the idea that the company was ripe for a resurgence. His videos, filled with data, analysis, and a healthy dose of humor, resonated with viewers, inspiring them to take a chance on GameStop. Roaring Kitty became the unofficial leader of the movement, a symbol of how ordinary people could use their knowledge and passion to challenge the status quo. To understand how GameStop became a battleground, you need to grasp the concept of short selling. Imagine borrowing your friend's car, selling it, and hoping to buy it back later at a lower price to return to your friend. That's short selling in a nutshell. Hedge funds borrow shares of a company they believe is going to decline, sell those shares, and then hope to buy them back later at a cheaper price, pocketing the difference. It's a risky strategy, but potentially very lucrative if you bet correctly. The problem is, if the stock goes up instead of down, things can get very ugly very quickly. As more and more individual investors piled into GameStop, driven by the momentum on Reddit and the influence of people like Roaring Kitty, the stock price started to climb. This created a problem for the hedge funds who had bet on its decline. Remember those borrowed shares? The hedge funds were now forced to buy them back at increasingly higher prices to cover their losses, further fueling the upward spiral. This phenomenon, known as a short squeeze, is like a runaway train, gaining speed and momentum as it goes, and it was about to crush anyone standing in its path. The GameStop frenzy sent shockwaves through Wall Street. Hedge funds that had been shorting the company were caught in the squeeze, hemorrhaging billions of dollars as the stock price defied all expectations. Melvin Capital, a prominent hedge fund, reportedly lost over 50% of its value in January alone. It was a stunning reversal of fortune, the kind that makes you question everything you thought you knew about the market. The big players, accustomed to calling the shots, were now at the mercy of a decentralized army of retail investors. The message was clear. The little guys had found a way to fight back, and they weren't going down without a fight. The GameStop saga raised questions about the future of the stock market. Had the balance of power shifted? Was this the dawn of a new era, where social media and online communities could dictate the fate of companies? While the long-term impact remains to be seen, one thing is certain. The events of January 2021 served as a wake-up call for Wall Street. The rise of retail investing, empowered by technology and social media, has created a new force to be reckoned with, a force that can disrupt traditional market dynamics in unpredictable ways. The stock market is like a roller coaster, full of unexpected twists and turns. It's a place where fortunes can be made and lost in the blink of an eye, where emotions run high and logic sometimes takes a back seat. The GameStop episode highlighted the market's inherent volatility, its susceptibility to sudden shifts in sentiment and speculation. It demonstrated that even in the age of algorithms and quantitative analysis, human behavior, with all its quirks and irrationalities, still plays a pivotal role in shaping market outcomes. The GameStop story captured the imagination of people around the world. It was a classic underdog tale, a story that resonated with anyone who had ever felt powerless against a larger, more established force. It showed that even in the seemingly impenetrable world of high finance, the collective power of ordinary people can make a difference. It was a reminder that the market, for all its complexities, is ultimately a human construct, subject to the same dynamics of power, influence, and rebellion that shape our world. The dust has settled on the GameStop frenzy, but the questions it raised linger. Has the market learned its lesson? Will we see more such uprisings in the future? Only time will tell, but one thing is certain: the game has changed. The events of 2021 have shown that the market is no longer the exclusive playground of Wall Street titans. Retail investors armed with technology and a thirst for change have entered the arena, and they are here to stay. So buckle up, because the ride is far from over.